Hello everyone, welcome to the weekly lecture video once again. And this is the third video of chapter 6. And in this video, I will continue to discuss corporate debt with some details, for example, different types of bonds, bond rating, difference between debt and equity, and so on. Okay. Look, securities issued by corporation may be classified roughly as either debt securities, or equity securities. Okay, debt represents something that must be repaid. Okay, so it is sort of borrowing money. So when corporations borrow, they generally promise to make regularly scheduled interest payment to repay the original amount borrowed. Okay. The person or the firm making the loan is creditor or the lender, and the corporation that is borrowing is called debtor or borrower. Okay. Now, from a financial point of view, there are some key difference between debt and equity. Okay. So first of all, debt does not represent an ownership interest in a firm. Okay. So debt doesn't represent an ownership interest. Okay, so the creditors, that means the lender, simply have claim on interest and principal, and they do not have voting rights. On the other hand, equity holders, that means the shareholders of a company, they have ownership interest. Okay. The next point is the corporation's payments of interest on debt is considered a cost of doing business and is fully tax deductible. Okay. Dividends, on the other hand, that is paid to the shareholders are not tax deductible. Okay. So that's the third point. So I already mentioned about voting rights. Okay. The next point is unpaid debt is a liability of a firm. Okay, so if it is not paid, the creditors can legally claim the assets of the firm, and this action can result in liquidation or bankruptcy. Okay, so which means that it's for a borrower, it's a legal responsibility that pay the interest and principal on time. On the other hand, a company is not obliged to pay dividend. So paying dividend is not a legal responsibility. Okay. And inability to pay interest and principal on time may result in bankruptcy, whereas inability to pay a dividend will not make a company go bankrupt. Okay. So these are the key point of difference between debt and equity. Okay. The next point we are going to discuss is the bond trust deed. The trust deed is a written agreement between a corporation, that means a borrower, and its creditors, that means the lenders or investor to a bond. Okay. Usually, a trustee, a bank potentially, is appointed by the corporation to represent the individual bondholders. Okay, the trustee must make sure the terms of the trust deed are obeyed, manage any sinking fund, and represent the bondholders. Okay, so it means the trustee, usually a bank, will make sure that bondholders' interests are protected. Okay. The trust deed is a legal document. It can run to several hundred pages and generally makes for very tedious reading. So it's an important document. However, because it generally includes the following provisions, like the basic terms of the bond, total amount of bond issued, the description of the property used as security, the sinking fund provisions, call provisions, and also there could be protective covenants, and so on. So these are the main points that are included in the bond trust deed. So let me be very quick in discussing each of these points. The basic terms of the bonds. The terms of the bond essentially is like what is the face value? Okay, what is the face value of the bond? And what is the coupon rate? What's the maturity of the bonds? Okay, so these are the basic terms of a bond. Okay, and a total amount of bonds issued. The total amount of bond issued essentially represent the amount of the fund a company is raising by issuing a bonds. Okay, and it also sometimes include the description of a property that is issued as security. Okay, so in this case, you need to understand that debt securities are often classified to the collateral and mortgage used to protect the bondholder. Collateral is a general term that frequently means securities that are pledged as security for payment of the debt. Okay, so for example, collateral trust bonds often involve a pledge of ordinary shares held by the company. Okay, the term collateral is commonly used to refer any asset that is kept as a security for issuing a bond. It also may include the seniority. The document also may include this term. Seniority indicates the preference in position over other lenders and debts labeled as senior or junior to indicate seniority. Okay, some debt is called subordinated, for example, subordinated loan. So in the event of default, holders of subordinated debt must give preference to other specified creditors. So usually this means that the subordinated lenders will be paid off only after the specified creditors have been compensated. Okay. However, debt cannot be subordinated to equity. So which means that debt holders will get their payment back before any payment is made to the equity holders. The bond document also includes the repayment mechanism. So bonds are repaid at maturity, at which then the bondholders will receive the stated face value, and they may be repaid in part or in entirety before the maturity. Okay, the sinking fund is an account managed by the bond trustee for the purpose of accumulating the funds to repay the bonds. Okay, the company makes annual payments to the trustee, who then uses the fund to retire a portion of the debt. The trustee does this either by buying up some of the bonds in the market or by a second option. Okay, we will be discussing this later. There are many different kinds of sinking fund arrangements, and the details will be written down in the trust deed. For example, a sinking fund may start several years after the initial issuance. Some sinking funds establish equal payments over the life of the bond. Some high-quality bond issues establish payments to the sinking fund that are not sufficient to redeem the entire issue. As a consequence, there is a possibility of a large balloon payment at the maturity. The call provision that is included in the document allows the company to repurchase or call part or all of the bond issue at stated prices over a specific period. Okay, so corporate bonds are typically callable. Okay, so the call price is usually above the bond's stated value. So bond issuer call the bond from the market by paying a price higher than its current market price, and the difference is called call premium. Okay, and the last point is the protective covenants. The protective covenants is the part of the trust deed or loan agreement that limits certain actions a company might otherwise wish to take during the term of the loan. Okay, so protective covenants can be classified into two types. One is negative covenant, another is positive covenant. Okay, so negative covenant is something that shouldn't be done. Okay, so it limits or prohibits actions that company might take. For example, the firm must limit the amount of dividends. The firm cannot pledge any asset to other lenders. The firm cannot merge with another firm. The firm cannot sell or lease any major assets, and so on. Positive covenants, on the other hand, is action that a company agrees to take or a condition that company must abide by. For example, the company must maintain its working capital at a minimum level. Company must periodically furnish audited financial statements. The firm must maintain a collateral. Okay, so these are some examples of positive covenants. Okay, so I already discussed these points that the bonds can be classified on the basis of the security. So it could be collateralized bond, it could be mortgage bond. So sometimes mortgages are on a specific property, for example, land or building of the company. Okay, so bond frequently represent unsecured obligations of the company. An unsecured note is an unsecured bond for which no specific pledge or property is made. The term unsecured note is generally used for such instruments. Okay, so you can see that bond can be backed by collateral, can be backed by mortgages, or can be unsecured too. We also learned about seniority. Seniority means the preference of bond payment in terms of liquidation. So senior bonds will be paid before any payment is made to the junior or subordinated bonds. We also discuss about sinking fund provision, call provision, and protective covenants. So let me say a few words for bond rating. Firms frequently pay to have their bond or their debt rated. Okay, so leading bond rating firms are Fitch, Moody's, Standard & Poor's. The debt ratings are an assessment of the creditworthiness of the corporate issuer. The definition of creditworthiness used by Fitch, Moody's, and S&Ps, Standard & Poor's, S&Ps are based on how likely the firm is to default and the protection creditors have in the event of default. It is important to recognize that bond ratings are considered only with the possibility of default. Okay. Earlier we discussed interest rate risk, which we define as the risk of a change in the value of a bond resulting from a change in interest rate. Bond ratings did not address these issues. So it only addresses the default risk, the possibility that the issuer might fail to pay. Okay, fail to pay back. So bond ratings are constructed for information supplied by the corporation, and the rating classes and some information concerning are such like high grade bond, medium grade, low grade, or very low grade. So high grade are, for example, AAA, AA, medium grade like BBB, low grade like BB, very low grade is like C. Okay, now this bond rating essentially allows the financial institute, bond rating essentially allows the issuer of a bond to set their coupon rate. Okay, a high rated bond usually will have a low default risk. As a result, they can be issued at a lower required rate of return. On the other hand, the low rated bond have high default risk. As a result, they must offer higher rate of return to investors. So you can see that high to medium grade bonds are called investment quality bond, whereas low to very low grade bonds are called speculative bonds. Now, speculative bonds are high risky, but there is potential for high return too. Thus far, we mostly considered plain vanilla corporate bonds. Let's know about the government bonds. When the government wishes to borrow money for more than 1 year, then it usually sells bonds, which is known as government bonds, to public. So when they are issued, government bonds have original maturities that are typically range from 10 to 15 years. Okay. On the other hand, when government needs short-term funds, they issue treasury securities or bank bills. Okay. Most government bonds issues are just ordinary coupon bonds. Some issues have an inflation adjustment to the principal, and a few have some unusual feature. The one important thing to keep it in mind that the Australian government bond issues, unlike corporate bonds, have no default risk because the government can always come up with the money to make the payments. Okay. State governments and government authorities also borrow money by selling bonds. Okay, so they are called sometimes municipal bonds. Government bonds, for example, treasury bonds are free of default risk. However, other state of local government bonds may have some degree of default risk, whereas corporate bonds always have default risk. Zero coupon bond is a special type of bond that pays no coupons at all, which means that it doesn't have any periodic payments. There is only one payment, which is the principal, and that is paid at the maturity. Okay, so that's why it is called zero coupon bond. Some zero coupon bond have been given exotic names like DINGOs in Australia. So DINGO stands for discounted investment in negotiable government obligations. Okay, so you can see that it doesn't have any coupon rate. So it is essentially a discount instrument. So it is issued at a discount, okay, and at the maturity, principal is given back. The next point we are going to discuss is the floating rate bonds. The conventional bonds we have talked about so far have fixed dollar obligations, right? Fixed dollar obligation because the coupon rate is set as a fixed percentage of par value. Okay. Similarly, the principal is set equal to the par value. Okay, so it means that typically a bond has a coupon payment and principal that are completely fixed. Okay, however, in a floating rate bonds, the coupon payments are adjustable. The adjustment are tied to an interest rate index, such as the current bank bill interest rate or any other benchmark rate. And the value of the floating rate bonds depends on exactly how the coupon payment adjusts are defined. Okay, so in most cases, the coupon adjusts with a lag to some base rate. Okay, a particular interesting type of variation on the floating rate bond is an indexed bonds. Such bonds have the principal adjusted according to the rate of inflation. Okay. Other type of bonds, so we already talked about subordinated bonds. So it's similar to conventional bond, except that in the event of liquidation of the firm, the holder of these bonds rank behind all other creditors. Okay, so since subordinated bond rank behind all other, it is usually unsecured lending. Okay, convertible bonds or notes have the option to be converted into company's equity. Okay. So for example, when a convertible bond has an option to convert into equity, it will be convertible to fixed number of firm shares according to the terms of the issue before maturity at the holder's option. Keep it in mind that this is an option, not an obligation. So holder, if wants, can convert it into equity. Okay. Once the holder proceeds to convert to share, their investment becomes equity capital and is no longer classified as debt. A given bond may have many unusual features. To give just one example, Bank of Queensland Limited issued an unsecured subordinated note. The issue is complex and harder to value than a standard bond. The nearby Finance Matters box provides information on this note in your textbook. Okay, so this is the end of our discussion on the bond features and different types of bonds. Thank you very much.